Maya was 27, a middle school teacher in Columbus, Ohio. She wanted to invest in real estate, but with student loans and a teacher's salary, buying a rental property felt completely out of reach. Then a colleague mentioned something called a REIT. 3 years later, Maya has a growing real estate portfolio and earns passive income every quarter, and she started with just $500. Today, we're breaking down exactly what REITs are, how they work, and whether they might belong in your portfolio too. So what exactly is a REIT? A real estate investment trust? Think of it as a company that owns and operates real estate, apartment complexes, shopping malls, hospitals, data centers, cell towers. You buy shares in that company, just like buying stock, and in return, you receive a portion of the rental income as dividends. By law, REITs must distribute at least 90% of their taxable income to shareholders. That's the key. It's real estate income without owning a single brick. When Maya first learned this, she said it felt like discovering a cheat code. Here's how Maya's money actually grows. REITs pay out dividends, usually quarterly, sometimes monthly, directly to shareholders. That's your cut of the rent, collected from thousands of tenants across hundreds of properties. On top of that, the share price itself can rise over time as the underlying real estate appreciates. And here's where it gets powerful. If you reinvest those dividends automatically, a strategy called DRIP, or Dividend Reinvestment Plan, you're buying more shares, which pay more dividends, which buy even more shares. That's compound growth working in your favor. Maya set up automatic reinvestment from day one. Not all REITs are the same, and this is where Maya did her homework. Equity REITs are the most common. They own the actual buildings and collect rent. Mortgage REITs, or MREITs, make money by lending to real estate buyers and collecting interest. They tend to offer higher dividends but carry more interest rate risk. Then there are sector-specific REITs. Healthcare, REITs own hospitals and senior living centers. Industrial REITs own warehouses, and data center REITs own the server farms powering the internet. Maya kept it simple and started with a diversified REIT index fund that covers all sectors at once. Let's look at the data, because this is the chart that made Maya pause and really think. Over the long term, REITs have historically been competitive with the broader stock market. According to NAREIT data, U.S. equity REITs have delivered an average annual total return of roughly 9 to 11% over the past 25 years. That includes both dividends and price appreciation. They've outperformed bonds significantly, and they've provided an important benefit that stocks alone don't always offer: regular income. Remember, past performance doesn't guarantee future results, but the historical track record here is worth understanding. Here's the number that really hooked Maya: 4.2%. That's the approximate average dividend yield for U.S. equity REITs, compared to just around 1.3% for the broader S&P 500. For Maya, starting with $5,000 invested, that's roughly $210 in annual dividend income just from holding shares. Not life-changing on its own, but here's the thing. As she adds more each month and reinvests dividends, that income snowballs over time. The dividend yield is one of the most attractive features of REIT investing, and it's a core reason many investors add them to their portfolios. Let's visualize what Maya's investment journey could look like over time. This chart shows the hypothetical growth of a $5,000 initial investment in a diversified U.S. equity REIT index, assuming an average annual total return of 10%, with dividends reinvested. After 20 years, that $5,000 could grow to approximately $3,600. Now add monthly contributions, say $200 a month, and that number climbs dramatically. This is for illustrative purposes only and doesn't guarantee any specific result. but it shows the power of starting early and staying consistent. That's exactly what Maya committed to doing. So, how did Maya actually get started? She opened a Roth IRA. That's an individual retirement account where your investments grow tax-free, and invested in a REIT ETF, which is a fund that holds dozens of REITs at once, giving her instant diversification. Popular REIT index funds track indexes like the MSCI US REIT Index and hold everything from apartment buildings to data centers. She didn't have to pick individual companies. Holding REITs inside a Roth IRA is especially smart because REIT dividends are ordinarily taxed as ordinary income. Sheltering them in a tax-advantaged account can make a real difference over time. Always consider your own tax situation and consult a professional. This is for educational purposes only, and that means we have to talk about risk because REITs are not a free lunch. All investments carry risk, and REITs have some specific ones worth knowing. First, interest rates. When rates rise, REIT prices often fall because investors can get safe yields elsewhere, and borrowing costs for REITs go up. We saw this play out in 2022 when rising Fed rates hit REIT valuations hard. Second, sector-specific downturns. Office REITs struggled significantly post-pandemic. Third, during recessions, dividends can get cut. Maya understood these risks, kept REITs as one piece of a diversified portfolio, and didn't panic when prices dipped. 3 years after Maya made her first REIT investment, here's where she stands. She's built up a REIT portfolio worth approximately $18,000, combining her initial contributions with reinvested dividends and market appreciation. At an average yield of around 4%, that translates to roughly $720 in annual dividend income. But with her DRIP strategy and regular contributions, her effective income keeps climbing. She never dealt with a broken water heater, a late tenant, or a property tax bill. She just invested consistently and let the compounding do the heavy lifting. That's the power of REITs for the everyday investor. Maya didn't need a down payment. She didn't need a contractor or a property manager. She just needed to understand what a REIT is and have the discipline to invest consistently. Today, her portfolio is growing, her dividends are compounding, and she's building real estate wealth on a teacher's salary. Here are the 4 things to take away. REITs let you own real estate income without the hassle of direct ownership. Start simple with a diversified REIT ETF. Use tax-advantaged accounts like a Roth IRA when possible, and always understand the risks before you invest. If you found this helpful, subscribe to US Wealth Logic. We break down wealth building every single week. Everything in this video is for educational purposes only and does not constitute financial advice. Always consult a licensed financial professional before making investment decisions. Past performance does not guarantee future results.